much, Eric, for the kind introduction. And thank you also, Anita, for the invite, and Jacob for the hosting. So Eric has introduced me. I will not do further introduction, so I'll just delve straight into tax, and I've titled this presentation as Tax 101. I've done tax for some times, and we've seen scenarios where when you're having a tax discussion, people switch off and sleep. So I've tried to make this as simple as possible to also make it suit us, because I appreciate that some of us may not be accountants, and some of us may not be tax professionals. So I've tried to minimize the tax jargon. Inadvertently, some tax jargon may be in there, but just that is because they are completely unavoidable. Okay, I have a presentation which I have titled Tax 101, and tried to separate it basically into direct taxes and indirect taxes. And of course, I've also tried to define what tax is, because quite often we see most of us saying the county government is taxing us so much, or county government is doing this, or wherever. So that is just the definition will just bring clarity on what tax is. And then there is also the legislative framework that governs the tax. And since it's about the Kenyan tax, so the legislation is just governing the Kenyan taxation system. So with that at the back pocket, we'll go through the introduction. And tax basically is a compulsory contribution to state revenue, levied by the government on either income or business profits, or on the added value on the cost of products. So just from that, the way I've said, even the added value is a compulsory contribution, and this is just of the dictionary definition. As a noun, is a compulsory contribution to state revenue levied by the government on income and profits. For businesses, that is now the side of direct taxes, and also on added costs to some products and services, which is basically indirect taxes. And just to preempt the gun, indirect taxes include VAT, which all of us are paying, knowingly or unknowingly, because when you go to the supermarket and you purchase products that have VAT, you have paid VAT, whether you know it or not. Yeah, and as an adjective, actually, tax is to impose a tax on someone, because let's face it, all of us, or most of us, given a chance, we would not want to pay tax. But maybe that is because we don't see visibly what the taxes are being used for, or they are not being used for, rightly so. So that is why it has to be imposed, or it has to be levied, or it has to be charged. So for tax professionals, such terms that are being used as charged, levied, and stuff. So generally, this is from a global perspective. We have several tax systems, and there are two large ones, which is basically the direct taxes and indirect taxes, or transactional taxes. The indirect taxes, those are the ones that we pay without knowing, because they are either levied on the transactions that we are carrying out, or they are levied on the products or services that we are buying or we are consuming. And the systems for indirect taxes is that they can either be on proceeds, or they can be on the value add. Yeah. And for direct taxes, we have largely three systems. The flat tax system, that is the same flat rate of taxes across, irrespective of whether you are rich or poor, or whether you are earning more or less. And then we have a progressive tax system. A progressive tax system for direct taxes seeks to tax the rich more than the poor. And by the rich, I mean that those who have higher income tend to pay more taxes than those who have lower income. And then we have a regressive tax system. This is basically punishing the poor, or if you have less, you get taxed more, and if you have more, you get taxed less. There are usually big debates on whether tax system is progressive, regressive, or which one is better. And at this juncture also, I think it's also important to just mention characteristics of an efficient tax system, because if a tax system is inefficient, consumers and general populace, allow me to use the Swahili word mwananchi, will be suffering more, because you realize that you'll be spending more, or they'll be charging you more to collect taxes from you. And paying taxes should be as painless as possible, and it should be efficient. So taxes should have equality. And tax systems should have some certainty. Unfortunately, like in our Kenyan scenario, we don't have that stable or much certainty as we would like. And just some very encouraging news good this year is that Parliament was considering starting to revise taxes after every 3 years. That one brings some level of certainty as opposed to the annual budget cycle that we go through where tax policy directives are issued. And a typical example is that you realize that a government can give you exemption in June of 2019, and those exemptions are withdrawn in June of 2020. So as a business or as an entrepreneur, you're operating in an environment of uncertainty, as most of us will be either running businesses or managing businesses or entrepreneurs. Having a 1-year cycle does not give you the certainty you may want. So an efficient tax system should have some certainty, which brings about stability. Again, paying taxes should be as convenient as possible. Like paying taxes should not be a chore, because here, first, you have been levied or you have a compulsory contribution that you need to make. So if making that compulsory contribution is also painful, then that does not make an efficient process. And also the benefits of collecting the taxes should outweigh the expenses in collecting the taxes themselves. So that is economy in collection. If you want to use 100 bob to collect 100 bob, it doesn't make sense. So there should be some, economy in collecting the tax. So those are largely the 4 characteristics of an efficient tax system that are applicable globally. We come to the legislation. Generally, as I said, taxes in Kenya are levied by the national government. What the county government levies are more of levies and other charges like cess, land access, or those other levies. But strictly speaking, tax is charged by the national government. And the overarching law that charges Kenyans and the people who derive income or get their monies from Kenya is actually the Constitution of Kenya. So we have other tax statutes, and all these are passed by Parliament. We have the Tax Appeal Tribunal. This basically seeks to arbitrate disputes between the tax authority and taxpayers. We have the Tax Procedures Act. Previously, before the Tax Procedures Act came into operation or came into being in 2015 or thereabout, I think, the different tax statutes had got their own different tax administration process. So the policymakers deemed it fit, which really helped to bring all these administrative processes for different taxes into one act of parliament. And that birthed the Tax Procedures Act. So Tax Procedures Act provides procedures for administration of all domestic taxes. We have the Income Tax Act. Yeah, that one charges as PAYE for individuals, pay as you earn, basically, and corporate income tax for companies, which is payable quarterly or annually, depending on which regime you choose. And also the withholding taxes, which is basically tax on income, but it is withheld at source. So it's just income tax paid in advance. And then we have the Value Added Tax Act. This is commonly known as the VAT Act, which deals with the VAT, which is an indirect tax that is charged on goods and services. And just as I mentioned earlier, when you go to the supermarket to buy your products, you are paying VAT to the government. So it is the seller who remits the tax to the government. Then we have an Excise Duty Act, and excise duty is interesting because this deals with the exercisable goods and services, and it's a form of an indirect tax. And let me just say something small on excise duty at this juncture. Traditionally, excise duty was known as a sin tax. It was tax that was more of being levied on what you can call luxury products, like alcohol and cigarettes. And the aim was to discourage consumption of such products because they had some harmful effects to the population. So governments all over the world, Kenya included, sought to discourage the consumption of those luxury products that had a harmful effect. So you'd reason that you tax such luxury products so that you get money to do public good, build more hospitals, build more roads and stuff. But we've seen evolution of excise duties. Actually, governments realize that, and Kenya government included, that we can actually make money from this so-called sin tax. So currently, excise duty is not really a sin tax because it's being levied on mobile telephony and even on some services, including financial services, which are not luxury services per se. Then we have Miscellaneous Fees and Levies Act. This one is another form of indirect tax, and it's some levies that are levied on importation of products, commonly known as a Railway Development Fund and import declaration fees. For importers of products and all that, you are aware of such terms as RDL and IDF. And then we have also the custom duties. Custom duties is an East African-wide tax, and the legislation governing custom duty is the East Africa Community Customs Management Act. And this is read together with the Common External Tariffs, which is abbreviated as CET. CET provides the tariff rates because when you are declaring a product, for those who've imported a car or you've imported any product, you realize that there is what they call the tariff code or the HS code. So these tariff codes are found in the Common External Tariff book, and the tariff code determine the rate of import duties that you will pay on your products. So I'll go directly to direct taxes. And the direct taxes are usually non-transferable taxes that are paid by taxpayer. By non-transferable, I mean that if you have an obligation in the eyes of the government to remit direct taxes, you cannot transfer that obligation to someone else. You have to deal with it. And a good example is like, for instance, a pay as you earn, which is paid monthly to the government. It is the employer who has the obligation to withhold the pay as you earn from our salaries and then remit the same to the government. So the employer cannot relinquish, or it cannot transfer that responsibility to the employee. For instance, I know I need to pay PAYE every month, but it's not on me to ensure that I pay PAYE. It's on my employer to ensure that the PAYE is withheld and remitted in time. My responsibility only comes in at the filing stage, which happens at the June for individuals of the subsequent year. For instance, this is 2020. So I just know somewhere that the employer is withholding tax, is withholding my PAYE and remitting to the government. The evidence of that I will know by June 2021 when I'm going to file my PAYE return. So it's incumbent on the employers to do the right thing first, tax employees at the right rate, which is currently, luckily, I don't know whether it's thanks to COVID or thanks to the government, the rate came down from 30% maximum to 25%. It's the employer's responsibility to withhold that tax and then remit to the government on a monthly basis. Corporate income tax, both the payee and the person who needs to pay it is the company, and it's payable on 4 monthly installments, but generally it's a tax that you should be paying annually. Withholding tax, as I had mentioned earlier, is a corporate income tax, but it's a tax that is withheld at source. For instance, for those who provide services, the consultants and even lecturers, I think, and all that, who provide services, you realize that if the person you are providing services to is a withholding tax agent, if let's say you are a resident Kenyan and you provide services to a person who is a withholding tax agent, when they pay you, assuming that your pay is 100 bob, they will pay you 95 shillings and then withhold 5 shillings. That 5 shillings will be paid to the government in the following month. Once they pay it to the government, you get a withholding tax certificate as evidence that you have remitted tax. So me, as Gabriel Okoyo, if someone withholds tax from me, then they pay to the government will give me a KRA, basically, will give me a withholding tax certificate. So at the end of the year, when I'm doing my tax returns, I need to get all the withholding tax certificates that I have, which luckily now they are in the iTax system. So you don't need to keep physical copies, but you need to go in and declare that I have already paid these taxes in advance, so that if there's any tax pending, you just pay the additional one remaining. Yeah, because the individuals, you need to be taxed at 25%. So even if you withhold 5%, it means that there is a differential there about 20% that needs to be paid. And I have to be clear that this one is on a net profit basis. You need to prepare, sorry for non-accountants, but you need to prepare what you call a profit and loss account, basically bring in your expenses to deduct from the gross income that you have earned. So that covers withholding tax. For the owners of commercial motor vehicles, that is the pickups, lorries, basically other vehicles other than the saloon cars, you need to pay advanced motor vehicle tax, which is paid annually. And also now we have rental income tax, that is a tax paid on commercial property. And then there's a capital gains tax. Basically, if you dispose of a property like land, house, basically there are some properties that attract the capital gains tax. So you also need to pay the capital gains tax. And the payee, they are just defined that the payee is a taxpayer responsible for the tax. If I use the example of providing a service and then a company pays me and then they withhold tax, I am the payee because it is me who's paid tax in the advance. And then the payer is the company which has computed the tax and remitted to the Kenya Revenue Authority. It's important that you know that both the payee and the payer have rights and obligations. And just as I say that direct taxes are non-transferable, if you do not fulfill your end of the bargain, either as a payer, as a payee, there are attendant penalties and interest that come in. And I have to say, as a payer, if you do not pay the tax, then when the penalties and interest kick in, they kick in as though you are the payee, as though you are the one who should have incurred that burden of the tax. So coming to the presidential directive, which came into effect in May after the parliament ratified it, just as I said, it's parliament that levies the tax. So the presidential directive was more, allow me to use the word, a wish list, which luckily enough, parliament assented to. Parliament passed and the president assented to it. So even if the government intends to reduce taxes or any quarters intends to give us a reprieve, parliament has to ratify that. And then once parliament ratifies, the president has to append his signature for it to become an act of parliament and for it to become law. So because of the presidential directive, the corporate income tax reduced from 30% to 25% for resident companies. And the same, the Tax Law Amendment Act that was passed by Parliament in May also had an overhaul of the capital allowance regime or the tax depreciation. So for the years commencing 2021, there's a new capital allowance regime. Unfortunately, the branches taxation still remained at 37.5%. So from the corporate law or the company act, there is two forms of vehicles for the businesses. Either you can be an incorporated company or a registered branch of an unresident company. So just take note of the different tax rates. When you're arriving at your taxable profit, you need to deduct costs and expenses. For a business, the catch is that those expenses should be wholly and exclusively incurred in the production of that income. So if you have a company, it's just good that you keep track of your receipts, and when you incur expenses, you should be in a position to justify that those expenses were incurred wholly and exclusively for the purpose of that company. Even if it includes holidays for directors, maybe you need to find a way to link it to say that you are still doing either business development or you're doing something. But if the expenses you are holidaying but not trying to work to generate the income for the company, ideally you should not deduct those expenses. Withholding tax on dividends paid to non-residents, that is basically non-resident shareholders, went up to 15%. Previously it used to be 10%. So for those who have companies incorporated in Mauritius, and then the companies in Mauritius have got subsidiaries here in Kenya or from wherever, when the Kenyan company is paying your offshore entities dividends, the withholding tax rate previously was 10%, but now it will be 15%. Yes, and then unfortunately, we have an introduction of withholding tax of 20% on sales promotion, marketing and advertising services to non-residents. Previously, these services were not subject to withholding tax, but now we see, since government has given us reprieve and relief in other sectors, it needs to show up for the tax shortfall. So that's the intention to tax non-residents more. And then the good news is that turnover tax, that was for small businesses, came down to 1% from 3%. And also the threshold for registration for turnover tax was also raised higher. So because of that, common businesses, the corner shops, the small entrepreneurs and all that who had initially from January been having the burden of turnover tax, that was lifted through the presidential directive, which was ratified by Parliament. Talking of withholding tax, I think it's important because, and this is based on the experience I've encountered when we were filing the individual tax returns for people in years that we've been filing returns. You realize that sometimes you do a job for a withholding tax agent, they withhold tax from you, but because people don't like to understand tax or try to, yeah, let me just leave it at understand tax. You realize that when you're going to file, iTax tells you that you have some withholding tax, that you have some income that you have not declared. And maybe you've even forgotten because maybe the gig you did that gave you withholding tax was in January of 2020 and you're filing at June or May 2021. You're barely remembering the jobs or the gigs you did in January the previous year, so that you start scratching your head wondering which income is this or which tax is this. So it's just important that if you have worked for someone and they have paid you and they have said that they have withheld tax on the payment, it just helps to log into iTax to actually confirm that you have that credit there, that you have paid the tax. Because as a recipient of a service, and especially if you have a withholding obligation and you are withholding tax agent, you are obliged to withhold tax. If you do not withhold, KRA will come for you at some point in future. And for once you withhold the tax also, is just you have an obligation to pay it. We've had cases where someone tells you they withheld tax from you, but then they don't pay. So when you're going to file, you are trying to declare a tax that was never paid. It's also a challenge. So all of us have a responsibility. If I've worked for you and you have withheld tax from me, please pay it to KRA. And from my end, if you withheld tax from me, it's upon me to just check that that tax has been remitted to the tax authority. Because if you don't, then that means that you've actually underpaid me for my services. And similarly, if you pay and I don't take note of that, I'll have challenges when I'm going to file my individual tax return if I'm operating as an individual. Similarly, if I'm operating as a company, then I may be losing some credit there. Mentioning withholding tax for non-residents, I think it will be unfair not to mention the double taxation agreements that currently exist between Kenya and other countries. And basically, the double taxation agreements are meant to avoid double taxation and avoid also non-taxation, because as some of us may have read in the media and in places, we have multinationals that can structure their transactions so efficiently such that they pay as minimum tax as possible. And as a tax practitioner, some people may beg to differ, whether it's ethical or moral or whichever it is. But as a tax practitioner, I can confidently say that tax avoidance is legal, but tax evasion is illegal. I'll take that again. Tax avoidance is pretty legal, it's provided for in the law. But evading tax is illegal and it's actually an offense. So this is where the DTA comes in to just ensure that even if you're avoiding tax, you don't avoid to be taxed twice. You avoid to be taxed twice, and also you avoid not to be taxed at all because you need to pay tax. Yeah, transfer pricing has a lot of technical jargon, but this really is the price at which related parties price the transactions between themselves for goods and services with the aim of achieving an arm's length price. And arm's length, I say arm's length to just mean that price that an independent entity would charge another different entity if they were doing business. Because, you know, for, let's say, I won't mention a local Kenyan company, but you have a company that you know, makes edible oils and cooking oils and all that, and then in the process you make soap and stuff like that. Or maybe you want to have a different company that makes the soap. You know, the base, basically the raw materials for making these two things could be one. It could be palm oil. You use it to make edible oil, and then the residues that remain and all that, you can actually mix them with other chemicals to make soap. Yeah, so while at transfer pricing, we have had measures from OECD that is driving the what we call BEPS, which is base erosion and profit shifting. So there are BEP action plans that are seeking to cure profit shifting by multinational enterprises, commonly referred to as MNEs. So this one ensures that the action plans are basically aimed at ensuring that where there is substance, where services have been rendered and there is substance to that, they get remunerated commensurately, such that you should not be giving more services, or we should not have a situation where multinationals are shifting their, you know, profits and all that to low tax jurisdictions after making them, let's say, in high tax jurisdictions. So in the process, we realize that the high tax jurisdictions don't have enough to tax because the companies there do not have a lot of profit because these profits have been shifted to low tax jurisdictions. And then there are multilateral instruments which also help implement, because we realize that some of the tax treaties that we currently have in force either were entered into in very earlier years and all that, and they could have been skewed in one way or the other. So what the OECD-led agenda is trying to do is to have the multilateral instruments that seeks to prevent base erosion and profit shifting. And Kenya recently signed a multilateral instrument in tax information sharing. So if you're doing businesses in Kenya and some jurisdiction somewhere else might be seeking that you are not saying the entire truth, they may reach the authorities in Kenya to ask for your information on taxes, because Kenya signed the MLI on tax information exchange. Well, Kenya participates in BEPS deliberations, but as an interested party. So it's not yet a signatory to BEPS. Yes, and this one, all of us, or many of us who are employees are familiar with it, the expansion of tax bands and also the reduction of the tax rates. So from the presidential directives, the top marginal tax rate came down from 30% to 25%. And similarly, the monthly personal relief, which was previously 1,400, has gone up to 2,400. These two factors combined for a basic taxpayer, so it raised the basic minimum non-taxed income by around 6,000 shillings. So the person earning, is it 12,800 and something, is not subject to any tax. Previously, it used to just be slightly above the minimum wage. Yeah. So the reduction of the tax rate and the expansion of the tax band, and this also reflects in the pension contributions and any withdrawal from the pension funds, is basically aimed at having more money into our pockets as employees, which is good news. And our hope is that even if COVID goes away, these rates and the bands should remain as they are, because it has increased the disposable incomes in our pocket, and which is a much welcome relief. Still on PAYE also, and this is also from experience, when you are filing personal tax returns, I'll start with insurance relief. Some of us may have taken insurance products, either life insurance, education policy, or health insurance, and then you understand, or you know that you have been given a tax relief. But there are some of us also who don't know how to go about it, in that when you get that certificate, you just keep it together with your other confidential documents and you keep it together with the policy without taking it to your HR. So this also seeks to highlight to you that you're actually entitled to a relief, and this is not a deduction, and a relief knocks directly against your taxes for the tax practitioners, or for those who care to look at the payslip, if you have one. There are deductions, like mortgage deductions, I'll come to that, and then there are reliefs. So a relief, basically, if I've computed your taxes, just the way you have a personal relief, if you have an insurance relief, I deduct this against the tax, and it's subject to a maximum of 5,000 Kenya shillings per month, which is translated to 60,000 per annum. That is good money, especially if you get that 60,000 in December. It can help in January. So basically, what needs to happen is that if you have an insurance policy and you've received your policy document, which most definitely will have a certificate from Association of Kenya Insurers, it's upon you as an employee to go take that to your HR or whoever processes your payroll, which in most organizations is usually HR or wherever it is, so that it is fed into your payroll system, such that when your monthly taxes are being calculated, you are able to enjoy that relief. We see in some situations where you just remember it's either halfway through the year, or you don't take it across. You just understand that I was told I have an insurance relief for tax, but I never get this. It doesn't come automatic. It needs some initiative from individuals to take that certificate and whichever documentation that your employer may ask, and you can easily obtain such documentations from your insurer. So if you have a policy, any insurance policy, please ensure that you are getting the relief you're entitled to. Similar to mortgage deductions, some of us may be having mortgages, and we have a mortgage deduction of up to Kenya shillings 300,000 per annum, which translates to 25,000 shillings. Deduction, you deduct it before you compute the taxes. But similar to the insurance relief, I've seen situations where people don't claim the mortgage deduction. You have a mortgage, you're entitled to the deduction, but just because you have not done the paperwork, basically taking the mortgage documentation, whatever you need to take to your employer, they don't know from that end. So it will be more like hearsay. We know you're entitled to deduction. Yeah, we know you have a mortgage, but where's the paperwork? So they don't come automatically. If there's one takeaway from this presentation and this slide is that we need to take initiative in terms of our own taxes to just ensure that we are compliant. Same to home ownership savings plan, you're eligible to that if you're under a registered home ownership plan. And just the way the government gives relief by one hand, also they demand more from the other hand. So there is a residential rental income tax that has been there actually. It's only that most people have not been complying. The residential income tax rate is 10%. So you either have an option to either pay 10% on gross from your rental income tax or pay 25% on net. By 25% on net, I mean you do the earlier profit and loss that I had mentioned. You prepare your profit and loss account, and then you deduct the expenses that you need to deduct from your rental income, and then you compute tax at 25%. Or you just pay 10% on your gross rental income, and then you are done if you own an apartment and you have any residential rental income. For commercial rent, those are presumed businesses, and they should fall under business, so they should be taxed as business profits, yeah, or business income. And the threshold previously, if you are getting income of less than 10 million, that is when you were subject to rental income tax. But through the Finance Act 2020, that rental income tax was increased to the income of 15 million. And this is effective January 2021. We also have a digital service tax. Yeah, this is a tricky one. Allow me to use that word, because it's a tax that is imposed on a digital marketplace. And yeah, everyone knows that people are buying stuff online. We have all these online stores, we have online marketplaces and all that, and they need to be paying taxes. But the bigger question is, how do you get them to pay tax? So effective 2021, we are here and we just pray and hope for long life so that we see how this will be implemented, because it's a tricky one. But there's a digital service tax that is payable at the rate of 1.5% on gross revenue from digital services. And if I may speculate from where I see it, I think the government is targeting the Ubers and the Amazons of this world to pay taxes, because fact is they are deriving income from Kenya, because we have Uber, people are shopping stuff online, and all those digital marketplaces are happening, but the government has not had a hold of it on how it will be taxed. And I think I saw through in the daily presses, there was an expression of interest where KRA was seeking to engage either a consultant to assist with collection of the digital service tax or something like that. But this will be effective from 1st January 2021. And if we have life and COVID behaves well, we will see how it will happen. And as a tax practitioner, allow me to use the word absurd in this, what happened in the last budget, that's the Finance Act. There is a minimum tax that has been introduced, and this is really not good for businesses, because this one seeks to tax you at 1% on your gross revenue. That means that even if you are loss making, especially if you're a startup, most probably than not, you will be having huge expenses as compared to the incomes that you have, or the money you'll be making. So most probably in your early years of operation, you'll be making losses. But then the government has thought it twice to ensure that there is a minimum tax that is imposed on taxpayers who are making tax losses and is payable in installments. And it's the greater either of the taxes you need to pay or the minimum tax. So if you're making a loss, talking at it from a layman perspective, it means that you'll have to go and borrow a loan to come and pay tax. Yeah, that's why I use the term absurd. Yeah, so we will see how this will be applicable from 2021 going forward. Now, that is more or less the direct tax part of the presentation. So we come to the indirect taxes, which are taxes that are earlier intimated that we are paying knowing or unknowingly. Yeah, and these are taxes that you can call them transferable. We have some like excise duties that are paid at the first instance of the manufacturer, by the manufacturer or the provider of services. But similarly, we have the value added tax, which is a tax liability that is shifted down the value chain up to the final consumer. So it's actually the final consumer who has the burden of VAT. That is a value added tax. But it's a tax. If I take an example of a product, I'm looking for a good example of product to use. Let's say yogurt. Yeah, so yogurt is manufactured by Brookside, and then we have maybe a wholesaler somewhere who distributes, and then we have a retailer, and then we have Gabriel Okoyo going to buy the yogurt from the corner store, the kiosk in the estate. When Brookside produced it, they charged VAT, and then they sell it to the wholesaler, who also adds a margin and then charges VAT and sells it to the retailer, who adds his margin and charges VAT, and then I go and buy it. So you realize that all the way from the producer coming down to the retailer, if they are VAT registered, the producer, I'm assuming, will be, the wholesaler would be, maybe the retailer is not. But once, if you're VAT registered, you have a mechanism of claiming what you have paid. Yeah, through the, whatever you can call it, the input output VAT mechanism. Yeah, so this is when you can transfer it. You transfer the obligation downwards up to, you know, the final consumer who will consume it. And the VAT rate used to be 16%, and thanks to the presidential directive, the VAT rate came down to 14%, effective 1st April. So now the VAT is at 14%, and I think we are the lowest. Tanzania's VAT is 18%, Uganda's I think is 16. So within the region, we are the ones with the lowest VAT rate, which is a positive thing. And then it's a tax that you pay basically on the value add. So the takeaway from this is that for the entrepreneurs, those who have businesses and you are registered for VAT, ensure that you file your VAT returns, ensure that you claim the VATs, because sometimes you realize, especially if you are a small business or you are operating out of a briefcase, sometimes we don't track expenses really well. We do not keep receipts. So we could be VAT registered, but we are not tracking expenses. We are more concerned with the VATs that we are charging our customers, that we are paying them. But sometimes we forget the VATs that we have incurred in what we have purchased. So it's important, if you're VAT registered and you're a business, to ensure that you claim all the VATs that you're entitled to, because that is your right. And then you charge VAT appropriately, and then you pay. Filing for VAT is 20th of subsequent month. That is the 20th of every month. The one unfortunate thing that came through for tax practitioners, you'll understand, is actually there were two. One, previously, before the Tax Laws Amendment Act, the transfer of business or transfer of goods as a going concern was exempt. Actually, before it was exempt, previously it used to be zero rated. That means that if you're selling a business, let me use an example of you have a stall in town selling mobile phones somewhere in a busy street, Moi Avenue or Tomboya. And then for whatever reason, you just want to change ownership. You are tired or you want to shift completely. You don't want to do that line of business somewhere in Gong or in all these places where people go to eat meat. So you want to dispose of the business that you have to another person who may be having that same sort of business. Maybe your next door neighbor who sells phones and all that. So you decide that you are going to sell that your business to the other person. If all of you are registered for VAT, previously selling such a business, you did not need to charge VAT because it was zero rated for VAT purposes. And then they moved it from zero rated to exempt. So you could sell your business or part of your business as a going concern, and you will not bother about VAT because the VAT was exempt. But now this Tax Laws Amendment Act came about and said now transfer of business or transfer of goods as a going concern is fully vatable. So that means that just selling businesses and transferring business has become a little bit more expensive by the VAT element, which will impact cash flows. Also, previously, when they introduced 8% on fuel and fuel products, the tax base for the VAT did not include other levies and duties. But my take is, I think from the reliefs that the government has granted us through reduction of PAYE rate and reduction of VAT rate, they say that they need more money, so they've increased the tax base. And now the tax base for fuel and fuel products is a bit more than it used to be. Yeah, for the importers of goods and services, there are these levies, yeah, that are little percentages, but depending, 1% of a million is a lot of money. Similarly, 3% of 1,000 or 10,000 is a little money. So they look as though they have lower percentages and stuff, but they are actually, costs that you need to consider if you're importing goods. And those ones are levied by the Miscellaneous Fees and Levies Act. And they are Railway Development Fund, no, RDL, Railway Development Levy, sorry, and the Import Declaration Fee. Their percentages varied and their percentages increased. For instance, IDF increased from, RDL increased from 1.5 to 3%. And also we had IDF being introduced in other goods that it never used to be. So this is just, increasing the levies that the government collects, but it's just making cost of doing business, especially for those who are importing products, a little bit higher than ordinarily it would have been. Similarly, we have customs duty. That is a duty that one has a higher percentage. So you need to take good care of it. And for some of us who've been, blessed or to have cars and to have imported our own cars and to do what, you realize that you had to pay duty at some point. And most probably this was paid by the clearing agent. So the takeaway from customs duty and RDL and IDF is that if you have imported and you are not the clearing agent, please ensure that if you've remitted or if you've given any money for tax payments, that these tax payments actually end up in government coffers at the right time. Because you realize you may have some, let me call them spooky or crooked clearing agents who will take money from you at the guise of going to pay duty, and they either pay less and declare, or they don't remit on time because they've done something with the money. And later, for those of us who've watched news a little bit, you've seen a few times these big cars being impounded because duty was not paid or it was disguised as what and whatever. So it's important that when you are declaring, or when your clearing agent is declaring what they have imported for you, you are aware. You look at the import documentation. Please take time to see what has been declared and the amount of duty you are paying to. And I think it's not too much to ask for, the receipts and the bank deposits and all that once it is paid, because we see mostly businessmen, we are concerned with making sales and doing the business, and then we don't look at the paperwork. So you've been giving money for duties, but these duties have never been paid. So when you are audited by KRA at some point in future, even yourself, you are shocked, because to the best of your knowledge, you paid duty, but your clearing agent did not pay. So it's important that you ensure that you confirm that the duty has been paid at the right rate, that is, the product has been declared correctly, and the duty has been paid at the right time as well. Yeah. It will help you. Sometimes it's a lot of work at the start, but it will save you the pain of penalties and interests when you face an audit, or when you can't get your tax compliance certificate to bid for a tender where the tax compliance certificate is required. We go to excise. Duty, and as previously I said, excise duty was known to be a sin tax, but so far it's ceased to be a sin tax. And largely there are different formats of, charging excise duty, either ad valorem or specific. And excise duty, again, is not levied on all goods, and similarly, it's not also charged on all services. So they're just exercisable goods and exercisable services that attracts that. And this is one form of those indirect taxes which you pay unknowingly. Yeah. And the excise duty structure refers to the manner and the rate at which the excise duty is applied on the base. So it can either be ad valorem, which is basically percentage based, or specific, which is based per unit, either per volume, per kilogram, or per weight, and or a hybrid of ad valorem and specific. And you realize that the excise duty is tax that is charged at the first instance. So this is not transferable downwards as the way VAT is. This is charged at either the provider of the service or the manufacturer of the good.
Very well, Gabriel. Thank you very much. And to everyone who was on this session, feel free to reach out to the alumni office at alumni@strathmore.edu. And also you can reach out to us on our social media handles. Let us know other sessions you would like us to have, and we can look for speakers to conduct those sessions. Otherwise, we'll let you know of the next session and follow us on our social media channels so that you are up to date with these sessions.